All right, we are about to kick off. We'll give folks 15 to 20 seconds to join in, and then we'll get started. Hey, Jody. Hey, John. Hey, Jenny. How are you today?
Great, thank you.
Great, thank you.
Hey, Diego.
Good to see
Happy
you.
Friday.
Happy Friday. All right, I can see the participant count spiking, so I'm going to get us started. The past 2 quarters of public reporting have made it clear that margin compression has returned with a vengeance. Today's panel will explore how top lenders are dealing with margin compression and will feature John Heck, who's a senior advisor at Capacity, Jody Hall, president at Nationwide Mortgage Bankers, and Jenny Massoud, director of analytics at the Mortgage Bankers Association. Based on my prep calls with the panelists, we should have an energetic and insightful discussion. Please feel free to contribute to the conversation by joining the chat or by dropping a question into the Q&A section. You can find chat and Q&A buttons at the bottom of your Zoom screen. Now let's get started. And this question is for Jody. You've been a senior executive at several mortgage companies and have seen a few boom and bust cycles in mortgage. What part of the cycle do you think we're in right now?
Thank you, Diego. And I first of all want to say thank you to our channel partner Capacity for inviting us to be a part of the important discussion today, along with their esteemed panelists from great groups. And thank you, HousingWire and Diego, for creating this space for us to have this conversation. I have been through several cycles, and I can say that, let's call it what it is. The last 3 years in the mortgage industry have been very little about mortgages. It has largely been about how do leaders pivot in times of events that are happening. And from the lead up beginning of the week, our discussion I thought was going to be very different than I think that our discussion will be today, given the events that are happening within the market. So I don't believe that we're in neither boom nor bust. I believe that we're in correction territory. Yes, we have a tight housing market where prices and rents are rising. But I think the focus should be on fixing the supply chain issues to meet the demand. Prices will flatten once the supply catches up. But I really do believe that the market shouldn't cause an emotional reaction. And that's so much of what we have seen largely since December. The fundamentals are strong. Every incentive is on the table for buyers, for builders, and for sellers to accomplish continued growth in the mortgage market. And rising home prices and rates are preventing a boom, but rising home values and the shortage of homes are also preventing a bust, because most of what we saw previously, and the trends are not repeating themselves. We saw that home values were falling when interest rates were rising, and it made a mess of the market. And that's not what we're in today. So I think we as leaders have to be able to manage through the emotional ups and downs of the mortgage industry and be those guiding lights to our clients and referral partners to educate them on what is going on within the market and what it will look like so we can keep them on the bench and buying homes.
Do you have any thoughts about supply? Like, are there any things that you would like to see industry do or government do to help in that area?
Yeah, I think that, it's about building affordable housing. And I think that it's going to have to be a combination of legislation stepping in and there being incentives to build affordable housing. We have to make it easier for builders to want to build affordable houses as opposed to building, a single unit at $500,000 because it is more labor cost and they lose less of their margin when they buy $250,000 homes. We also, so by incentivizing the builders, we should also be incentivizing them to use technology and to be able to decrease the cost it is for them to be able to build so that we can create more affordable housing. The other battle is going to be with different with different regions of the country where they're trying to prevent multiple housing units coming in. And so land is becoming even more of a shortage, even if we incentivize. So I think that it's going to take a lot of different pieces to close the gap in the lack of housing.
So this one's for John. You also have a long history in the housing industry. What got you excited about advising for capacity?
Thanks again for being part of this discussion. I look forward to it. Well, I've got over 3 decades in the industry, so I've seen a lot of these S curves that Jody just referenced, and it's kind of survival of the fittest. I was working at IBM, and I was involved with a group of people, a team that was focused on getting Watson AI, blockchain, cloud, and digitization focused on specifically the mortgage industry. And one of my clients was a senior executive at a large institutional investor. He left his role and started a hedge fund and actually invested in capacity in one of the early rounds and called me up. And because of my background, he said, you should meet these guys at Capacity and see how you can take some of the things you're focused on and work with these guys, because they've got some really good AI solutions. So I flew out to St. Louis. I met with David Grandish, the CEO, and Tim Eden, who's the Chief Revenue Officer. And we spent about 4 hours on a whiteboard. At the time, they were really a point solution company. And we talked about their transformation into being a support automation platform. Basically, a platform that runs in parallel to multiple systems of record, third-party ancillary services, both fintech companies and providers, where the data, we have to kind of remind customers all the time that the customer owns the data, not the system of record. So the more you can run in parallel to systems of record and kind of lay on top as a kind of intuitive middleware, greater efficiencies you get. So I was, walked out of that room having met 2 really smart people that really weren't fully vested at the time in the mortgage space. They were in multiple lines of business. And I remember David, who's a very intelligent man, saying to me, the mortgage technology can't be this bad. And I said, no, let's put it this way. The bar is on the ground. Okay. If you're going to do the limbo, the bar is on the ground. There's nowhere to go but up. So I'm excited to be part of Capacity and really excited about all the transformations they've made over the last couple of years.
Jody, how are you engaged? You and Nationwide engaged with Capacity? What's your relationship?
They are really a strategic partner of ours. We've always been a company that is buy versus build. Since I started with the company, we've been really vetting third parties to make sure that they're a right cultural fit for us as an organization. And I was introduced to Capacity, and we started using them first as a virtual help desk. So we have Ask Rosie that is powered by Capacity, where our employees can answer any guideline questions, standard questions like, how do I input my PTO? How do I submit an expense report? You name it, Rosie can answer those questions in a matter of seconds, which frees us up. You think about when you're onboarding new employees, as we've seen a tremendous amount of growth at the company. And when you're onboarding employees, you get the same questions. It's redundant. With Rosie being able to answer those questions for them, that gets the employee not only out of the email box, but it gives them the answer to the question in 2 to 3 seconds. So I can't type an email that fast. I'm not that good. So even if I were sitting there waiting for it to come in, they're getting their questions answered faster than they were before. And then that allows us to focus on other technology, or really the strategic vision of the company, and driving the company forward and building the careers of our employees. The other way, our path forward with Capacity is we're going to work with Capacity and their automated workflows to be able to automate all of the processes that are outside of the mortgage manufacturing process. So when you look at human resources or even the accounting team, there is a lot of opportunity to automate that workflow so that people are not having to go in and enter a date that someone completed something that kicks off the next task. So we're working in partnership with them to build out all of the automated workflows that are outside of the loan manufacturing process today. So we're very excited about our work with them. And I think more importantly than the work that they do is the relationship that we have built with them. They really see my problems as their problems and have been a strategic partnership that has allowed us to continue to grow.
Yeah, it's important to have vendors that are partners. That's really important in any business. John, Capacity recently did a funding round. Can you comment on that round and what it's going to enable you to do in the marketplace?
Yeah, the co-founders of Capacity, David Krandish and Chris Sims, had founded a company earlier called Answers.com, which they sold for about $900 million. So these guys they know what they're doing. They recently closed out a Series C round of funding, and I think it was about $38 million, which takes the total to over $62 million. I don't know the exact head count of Capacity, but I think it's about 100 FTE, somewhere around there, plus or minus. What I love about working with Capacity, being a mortgage person, is that they're really bright engineers that can figure environments, and they ask these questions like, why are you doing it that way in mortgage? In so many other industries, we're doing it this way with these tools. And I always respond and say, let's use those tools to get rid of those legacy disparate systems, because they're environments. You need open data exchange environments and all the self-sovereign stuff that we're talking about, consumer permission data. So it's a great group of people that have become very, very smart in the mortgage space, specifically the people I work with. And they look at it much differently than the typical mortgage technologist, which is really encouraging from my perspective, having worked for IBM and EMC, some of these big tech companies.
Appreciate that. So now this one's for Jenny, who works on profitability reports and other lender profitability analytics for the MBA. Your last report, the Q3 2021 report, showed improving profitability, but also near record level costs. What trends did you see in the Q3 report, and do you have any expectations for the Q4 report that will come out next month?
Thanks, Diego. So yes, the performance report, we sample over 350 independent mortgage banks, and the report contains data on revenue, expense, profitability, and productivity. And it is unique in that we have access to a large sample of IMBs to be able to report on profitability. So in Q3 of 2021, we did see 92% of IMBs in our study have a pre-tax net income greater than 0. So this was across both production and servicing business lines. Average production volume across these over 300 IMBs was about 1.2 billion in Q3. And yes, production margins were at 89 bips, or about $2,600 per loan. So a year before that, in Q3 of 2020, we had margins of over 200 bips. But if we keep it in context, over time, the average origination margin over the last dozen or so years has been about 50 bips. So 89 bips is still pretty good. Excluding 2020 and 2021, the last time we had production profits higher than 89 bips was actually in 2012. So again, putting it in context, declining, but still relatively good. And then to your point about increased expense, expenses were at the second highest level ever reported. So we were at $9,100 per loan in Q3. In Q2, we were at about 8,600. So quite high in Q3, and mostly driven by rising personnel expense, right? Especially sales expense, which was also at a steady high. And we are seeing that high sales expense because we also saw the highest average loan size for first mortgages of $308,000, right? And high average loan size means that sales costs are also going to be high. Production revenue increased more than 20 bips, and that was sort of the saving grace for the net production income. And then in terms of productivity, we saw median sales productivity at about 5.6 loans closed per month per sales FTE. So we are just getting the data in now for Q4. So we will have those results out the third week of March.
Any insights that you've gathered so far, or we'll have to wait for March to hear that?
I think we're going to have to wait for March to hear that. You know, typically in a purchase environment, right, we typically see a lower net production income. So that's.
All right. So Paul in the chat, Paul Campbell asked about increasing mortgage rates, and that was actually one of our prepared questions as well. So I'd love for the panel to talk about, mortgage rates are blowing past industry predictions. We're already above 4% in some indices. I guess we'll start with Jody. What do you think these higher rates mean for the housing market and for mortgage origination in 2022?
So I love what Jenny said, and we have to put everything into perspective. So even at 4%, even up to 5%, interest rates are still relatively low. Just yesterday, we saw, with having the Russian invading Ukraine, we're seeing a completely different picture than we saw on Monday, right? With where interest rates were going. I do think that the invasion is going to cause the Feds, which we've seen, and it was predicted that they would increase the short-term rates by 50 basis points. And now it sounds like they're going to stick to the 25 and raise slower, wait and see what happens. So that's good news for us, just from, the emotional perspective, more than anything. So even though interest rates are on the rise, people still need to buy homes. We also have to remember that rents is rising everywhere, historically high rents in many of the metropolitan areas where home buyers could go with being able to be remote even further out to buy homes and be in a better financial situation at a higher interest rate than continuing to put their money into renting. So I do believe that, with rising interest rates, it's a matter of, like I said before, taking the time to be that guiding light to our clients and referral partners so that they see the positive and not just get down because of what the interest rates are and really put it into perspective. So I do think that interest rates are going to continue to rise throughout the year, but I don't think it's going to be at the record-breaking levels that we have seen. If we go back to 2019 interest rate, it's not going to be the worst thing that happened to us in the market because home values are still rising and the consumer has more liquid assets than they have historically had.
John, would love your perspective on this one.
Well, I'll date myself. Like I said, I'm 3.5 decades in the industry. So I remember double-digit interest rates as a loan officer when I first started in this industry. I think the reality is we're not going to see profitability like we saw in 2020, just because it was more order taking than it was anything strategic. I think the bottom line is that the two entities that I think I would focus on as a lender would be the millennials, because they want to do business differently. And I think the non-agency investors are looking at more digital solutions that I think are pretty interesting. They're going to match up pretty nicely with the millennials. I think you need to offer, in a higher interest rate, you have to steal business from your competitor. I mean, I don't want to say it in a negative way, but as the market compresses, it's about redistributing business. So you've got to have a better value proposition for the consumer. You've got to have a higher percentage of closing to applications. The worst thing you can do is take a lot of apps and not close them. You don't make any money. And I think you need to look at times. Jody was mentioning, I call it accrual accounting. It's always totally not focused on in a mortgage operation. They look at things that need to be done and they don't track them from an expense standpoint. So it's, it's Six Sigma days of 1990s, which I was a big part of. You had, 8 different printers for specific desks so people didn't have to walk and pick up their paper to save time. All of that adds up. The more you can automate the mundane things that somebody's got to leave a system and key in another system, it truly adds up over time. And the question I always rhetorically ask this industry is, we have the most sophisticated technology in the history of the world. and it's costing us more to originate a loan in the history of the mortgage banking industry. So how does that fit? It fits because people have not innovated and looked at how to take tactical solutions and fit that into a strategic business plan that they're executing short, intermediate, and long term. I think too many people look at shiny objects thinking it's going to fix something. And all it does is create many times more of a problem, because if people aren't warm and friendly about change, especially if they have to change the way they do something, they don't like to do something differently, and they don't. So it almost becomes counterintuitive. The other thing that I think is really critical is, as non-QM, non-agency business, jumbo business, and some of these new products that are coming back, by the way, some of the products that I thought would never come back are coming back, that whatever you're doing to your sales team and your ops team, it's got to look similar to what they do on a day-to-day. You can't have multiple lines of work, multiple assembly lines that you have to train different people to operate in different systems to do different business, because that also becomes counterproductive. And the timing factor becomes an issue. It takes forever to close a loan, and time is never a problem. The last thing I would look at is, going back to Jody's point, how do you change your focus now? There's less rate and term refi, so that means there's more cash out refi. More cash out refi, there's tax limitations around what you can do with that write-off. If I were in the sales part of this business, I'd be talking to accountants to get business for cash out refi. As rates go up, there's logical reasons for people, even at 6%, to refinance their homes and take money out for home improvement, for what all the tax, the tax issues that we can get compensated for. The other issue is, and Jody mentioned it again, is the relationship management part of getting to what I call channel distribution sources, builders, big realtors that do a lot of volume, and building the relationships with them, and being completely upfront and honest with them about what you can and can't do, and follow up with what you say. I think that's the reputation of actually getting something closed is critical.
Jody, John said most technology in the history of the world, highest cost per loan in the industry's history. What's going on there?
He said it. It's people unwilling to change. I, being in this industry for a long time, we've been talking about, hey, why are we still doing this decades-long process? We're doing the decades-long process because that's what people are comfortable with. And also, to John's point, if you have people in multiple systems and you're interfering with their day-to-day business, they feel like they can't function. However, we need to be able, as an industry, to meet people where they want to be. If you would have told me 5 years ago that I would have been ordering my groceries on my phone, or even having home delivery on my phone, I would be like, there's no way I'm putting that information in. I don't want someone showing up at my address with my groceries. But times have changed, and we have to be willing to meet the clients where they are. And that gives a much faster mortgage process. We have a platform that it's called FasterFi, which is it's a test kitchen for our technology. But we're able to move loans through the process much faster and with less friction. So we're taking what is already a very paper intensive, arduous process, and we're breaking it down to a question on your phone, one question at a time, and meeting people where they are at by giving them the ability to do that application on their phone, getting them interest rates in front of them very fast in the process. And that's where they're at. Now, what we have to do is make sure that our loan officers aren't doing business so completely different that they feel uncomfortable and they can't serve that client. And it definitely is a healthy mix of the culture of who you want to be and the technology that is out there to be able to do the job. People hear technology, they think that they're being replaced. We are a relationship business. People are not going to be replaced in this industry. And we look at technology such as capacity and other workflow automation that we work on in the manufacturing process. We look at it as an opportunity to free up not just our loan officers' time to have those conversations with clients and referral partners, but also internally for an underwriter to have the time to have purposeful communication with the processor and the underwriter, or the processor and the loan officer, and say, hey, this is what this condition is, but I can take this, and it moves it through much faster, even though they can have more communication with each other. So it's a hesitation to change. Change is hard. And we're fighting an industry that is really dug in and hasn't evolved a great deal from the loan manufacturing process the last 10 years. And, you hear, well, if you're going to change the way I do business, I'll go work someplace else. So it's definitely a balancing act and something you have to be extremely strategic about.
Jenny, how does the MBA look at technology integration and profitability? Is that something that you're talking with the IMBs about when you create that report? Is that something that they report on when they talk about profitability?
So not in the performance report. We do have a line for tech expense in there, which basically just tracks the LOS expense. But we do have various. So we have Rick Hill runs a CIO forum there. And part of that, I help him with a technology profile survey. So it measures basically what technologies lenders have in production. We've been doing it for about 4 years now. And we have seen, in terms of mortgage specific technology, in closing technologies, we have seen an increase, from 2020 to 2021 in technologies like hybrid e-closing, e-signature of the note, deed, and RON, although it's still low, but we've seen an increase. In other words, lenders have tried to adopt these technologies. So for example, I believe hybrid e-closing was offered by like half of the lenders in our study in 2020, and in 2021 it was about 80%. So. And the other thing is the borrower usage of these technologies is also increasing, of course, not at the rate that the mortgage companies would like. That I think they want to evaluate the ROI immediately. It's hard. But still, for both application technologies like the POS, the customer document upload, the e-signature of the 1003, customer usage of those technologies has been increasing. And, in terms of measuring the ROI of these technologies, I think that's a big thing that companies want to do, right? And so they can look internally and they can readily assess, whether adoption of these technologies has an increased productivity, better cycle times, reduction of costs, improved customer satisfaction, those types of measures. And then the next step would be, this is where benchmarking really comes into play. And if companies aren't benchmarking, they should definitely start, to see if your company is on par with like modeled companies.
Jody, I'd love to get your perspective on this a little bit more. In our prep, you talked about, you're growing really quickly. You're able to recruit people right now. Is tech part of that conversation? I assume people want to go somewhere where they can stay, and you're not going to do the accordion hiring and firing that can happen at a lot of lenders. So how do you weave tech and battling margin compression into your recruiting conversations?
Yeah, absolutely. By applying technology, and we use a lot of technology that doesn't interfere with the mortgage manufacturing process. I say interfere just because people are change resistant. When we're applying robotic process automation, we're looking at doing things like order outs, things that stay out of the way of the loan officer that can happen behind the scenes 24 hours a day. And we have been extremely fortunate in our growth. In 2020, it was next to impossible to hire underwriters and processors. So we have always been a company that wanted to grow and promote within, and we had the opportunity to train processors into underwriting positions and to grow their career within the organization. And we were able also to apply technologies that would take care of some of the underwriting functions. So we weren't going out and paying astronomical prices to get underwriters, and knowing that we potentially would have to let them go in this environment when rates are rising. So we never were in a position, because of the technology that we had in place, we were never in a position that we had to have massive layoffs as production came down. But we used the technology to be able to expand our capacity to produce loans during those really, heavy refi times. But then we can slow the technology down when the production slows, so that we don't have to have those massive layoffs. And that's what we've been able to do. And from a recruiting perspective, we have continued. We speak about technology and culture. It's at the primary focus. We're a people first organization. We will never let go of an employee that is a good employee, even if we don't have a place for them, because we know we're going to need them in the future. We also hire, even though when we're in times that might not look like we should have to hire, because we're looking for the best people in the industry to join us. And that allows us to have a really competitive advantage in the market, because we're out there, we're selling the same interest rates, we're fighting the same market compression. But when we're speaking to potential branches, and we can talk about, we have this technology so that it can help speed up the process. And in speeding up the process, you're going to win more business, because you're doing like cash offers on properties because of speed and ease of closing through the technology. But at the same time, you get to speak to an underwriter. You get to speak to, the founder and the president of the company with any ideas or anything that, you are struggling with, because we can stay relatively small while we're continuing to add production, because that we can allow the technology to take care of a lot of the work.
Yeah, that makes sense. John, we've had a couple questions come in that remind me of something you said during our prep. You said 2022 is going to be survival of the fittest. And so there's a question that came in that asked about lenders cutting margin, to below profitability, in order to stick around. What do you think makes a fit lender? And could you just give us a little bit more on why you think 2022 is going to be survival of the fittest?
Well, I think that, general 30,000 foot statement, there's a couple of big players that are monopolizing the industry. We won't mention their names, and they're doing it through automation. One of them is probably a really phenomenal marketing company that happens to do mortgages. I'll put it that way. I think that the reality of operating a business, and I'll go back to running a big region for a national lender. I would know what my business expenses were after the month closed, and accounting would bill me. I had no way to control my expenses. I think having the ability, and as Jody alluded to earlier, the more you automate, especially with AI, the more you can actually track from a timeline standpoint how long it took to do something. And you can actually auto-generate operational reports to tell you almost in near time what it's costing you to produce a widget. And there's a diminishing economies of scale that exists with just general math. If you have 100 people that are making 1.9 decisions a day, and you hire another 100 people, you're not going to stay at 1.8 or 9 decisions a day. You're probably going to go to 1.5, because the talent pool starts to diminish itself on the bottom. So now you have to top size people. You have to change people that are the performers you want. And now you have downtimes and scalability issues and everything else. So I think you have to look at 3 areas of your business, in my opinion, oversimplifying. You have to look at your apps. How are your apps involved with your manufacturing process? are they all collaborative and working collaboratively in generating better output? That's the first thing that I see people going through these. It took me 6 months to integrate to whatever fintech company it was. And now I've got to go in there and do something differently. And it's a change in workflow. It has to be, and not to sell capacity, but we want people to white label our solutions. Jody uses Rosie. We give you the technology. Just go ahead and name it and tell us what you want us to do for you so that this is your environment. I think that's really critical. The overall fintech phenomenon has to be invisible to your manufacturing process. It just has to work. The second thing is documents. We talk about, I had a CIO tell me one time of a credit union. I thought this was a brilliant statement. He said, all you guys want to do is digitize our environment, but the darn investors want the documents. So it kind of was an aha moment. I thought, there's some logic there. You have to have the capability of operating on a metadata level. And the way you do that is you have to be able to extract, you have to get source data, you have to get data from federated repositories that computers or the consumers give you permission to do. You have to have the ability to extract data from documents. You have to classify them, you have to extract data, you have to be able to auto-redact, you have to form feed that data back into a location where it needs to go without anybody doing anything. And the only time people get involved in that process with good sophisticated systems is if there's an error or if there's something that can't be logically extracted. It goes to somebody that does something with it. I think the last piece is what I call tacit knowledge. What AI and workflow and knowledge bases and neural networks and machine learning and natural language processing does, it diminishes the overall requirement for a lot of really smart, seasoned professionals. The more you automate the knowledge that's needed to have metadata reacted to, the less you need to rely on people that are making those decisions. And the other part of that is technology is much more consistent. Even if it's wrong, it's consistently wrong. There's not a standard deviation with people. I remember getting in a discussion with a subprime executive about underwriting. And they said, you can't use automation in subprime, can't do it. And, I won't get into the details, but the reality is if you have a standard deviation of 30% with underwriters, you got a big problem if you're approving loans because you got some issues with resaleability. I think that the overall simplification is you have to have a collaborative, a support platform for your fintech, your apps. You have to have a way to digitize your environment. And the best way of doing that is to have a database where you own the data and you can do with that data what you want. And you have to have ways to rely less on highly sophisticated people that have been doing it for 30 years that still have a standard deviation of decision making that may be an issue down the road. And I think automation proactively does address that. And the last point is, we all talk about decentralized data and self-sovereign, consumer permission data. It's going to the point where we on our iPhone, as Jody mentioned, we're going to be the power source for releasing data to wherever we want it to go. And, little examples like spell check on the iPhone, which drives us all crazy because you send a message to somebody, it's the wrong message. It does learn. My phone learns when I use a certain acronym that, okay, that's not a bad spelled word. It learns it. With machine learning in manufacturing, capacity is at 90.4% of affirmative responses. Whatever question is asked of us, we give the right answer back almost 90.5%. To Jody's point, that keeps people off the phone because consumers, God love them, they ask the same questions over and over again on every application, and that costs money. So I think it really comes down to apps, docs, and tacit knowledge. I think there's the three areas that technology needs to be proactively addressed.
Jody, I'd love for you to riff on that a little bit. I mean, you're planning on not only surviving but thriving in 2022. You're on this pretty significant growth trend. What are you doing to engineer that kind of growth within your organization during a time when I think we're going to see some people kind of fall by the wayside?
Yeah, for sure. So we are continuing to develop automation, again, trying to, as John said, stay out of the way of the manufacturing process, which will allow us to be able to scale. I say this, and there is like, I'm no analyst like Jenny, but I always say I want to be able to double our volume with 20% increase in our non-sales staff. And I really think that the way that we get there is workflow automation, both on the loan manufacturing side and also on the non-loan manufacturing side, making the work much easier. So that's what we're continuing to do, with the expectation that we can still continue to feel like a small boutique mortgage lender by not blowing the doors off and hiring, a ton of support teams to be able to manage the incoming loan officers and the sales staff that is coming, that is bringing the loans in the door, and fully being able to support them from the technology perspective. So again, that they can do more loans. It's not about getting rid of the loan officer. It's not about, getting rid of the salesperson. It's putting more time back into their day that they can choose how they spend that time. Maybe, people want more work-life balance, like the process has been too hard. They already produce a great living that they're comfortable with, and they want to put that time back into their family. Or they can use that freed up time to develop deeper relationships with their existing clients and referral partners, which is in turn going to increase their business, so that they can continue with the same amount of effort to get more production individually. And that's what's going to continue to grow us as an organization, is going to continue to attract top talent to our company.
Jenny, when I look at 2022, I'm really worried about the first-time home buyer. And Jody kind of referred to affordable housing supplies as an issue earlier on in the conversation, and there's been a couple questions on this topic. When you have mortgage rates potentially going up to 4 and above, when you have record low inventory and record high home prices and home price growth, that's a really tough situation for the first-time home buyer. And mother demographics, as our lead analyst Logan Mohtashami likes to point out, we've got 2020 to 2024 just an incredible number of millennials who want to be first-time home buyers. What do you think we can do about that issue in this environment?
Well, yeah, that is a very difficult situation. MBA has an affordable housing pledge going on right now for companies to sign. So that in and of itself is very important. It's about nurturing the relationships. I think, those first-time home buyers will probably take longer, obviously, to get them to where they want to be. I mean, MBA is, we just in our forecast this morning, actually, so our 30-year interest rate right now is a little over 4%. So, it's not horrible, but it is going to be more difficult for these people. I wish I had the answers. It is a really hard question to answer, honestly.
Jody and John, would love your perspective, like the industry perspective on what can be done to keep these folks motivated and from sort of bowing out of wanting to join the housing market. What's your perspective, Jody?
Yeah, so there are other tools that are available that helps relieve the stress of rising rates, down payment assistance programs that help first-time home buyers get into homes. I think that we're going to see an increase in the number of HELOCs and second mortgages to be able to reduce PMI for those first-time home buyers. And I think that, it's largely, I keep going back to this. It's about getting to them emotionally. And, because if you Google the housing market or you listen to the news, all you hear is doom and gloom. And, hearing rising interest rates and also with inflation, it's going to put some people on the bench. There's no doubt about it. People are going to meet their needs and their families' needs before buying a home. If they think that, gas prices are going to be too hefty for them to be able to go to work, or they worry about what grocery prices will be because of inflation, they may back out of the market. That's going to happen. But I think that the best scenario is that we as mortgage professionals educate the first-time home buyer on what is available to them to keep them interested in the market. And we also have to educate our referral partners because they're reading the same headlines, they're reading the same news. It's all doom and gloom, and it doesn't need to be that way. So the more we're able to educate our clients and referral partners on what programs and platforms are available to them, the better off we're going to be, and the more home buyers will keep in the market. A little bit less home buyers in the market isn't a bad thing, because then the housing prices will level out, which will also help the first-time home buyer as well.
John, any additional?
Yeah, I think there's the thing that I think it was about 2 weeks ago, I read that the average loan amount was $453,000. And I went, whoa. I mean, how is a 22-year-old kid or a 25-year-old kid with a regular job going to afford, a house? I think the change, I'm working with a group of people, which I'm really excited about working with, that are looking at automating the industry a little bit differently, looking at data certification as part of the application process, looking at putting assurance wrappers around risk mitigation for ultimate investors. Mm-hmm. These are people that are, they're people that have a lot of money, that want to make money. They want to lend with a little higher coupon. And I'm not talking about specifically non-QM. I'm talking about good mortgages, but to have recourse built into the mortgage that follows the bond. I think that the capital markets people, other than the GSEs, I think are going to be instrumental in providing some of these solutions, because if you talk to any insurance company about actuarializing anything, they do it extremely well. They know how to look at, in Jenny's world, they know how to predict risk. So you can price it accordingly, and you can create tools that make for expeditious trading. Non-fungible tokens is a term that we don't use in the mortgage space, but a token is being traded as we speak out there. I can sign up with a trading platform with crypto, 30 different platforms just by signing up, and pay a small transaction fee for a trade. I think that's also part of what's going to change the secondary market and the capital market. It's finding new ways to bring liquidity to niche parts of the industry where it's a good deal for everybody. It has to be a good deal for everybody, for the home buyer, the lender, seller, and the eventual investor. And for it to work, it has to work for the investor. They have to get their ROI. And I think the way to do that is through some risk mitigation protocols that they're talking pretty seriously about with automation, which is pretty exciting, actually.
I've been reading about the 40-year mortgage. Any thoughts on that, Jody, as something that could potentially help a first-time home buyer? Too much risk? Like, what's your gut reaction there?
Whatever payment they can afford, right? Because the likelihood of them staying in a 40-year mortgage for 40 years is slim to none. most likely going to move 5 times. They're going to own 5 homes, I think is. It may even be more than that. Jenny might know the number better than me, but as long as the investor is okay with the risk and, you know, the borrower can manage the payment, then, you know, I'm for it. And I do think, you know, to that point, we as mortgage professionals have to look deeper. You know, when rates are low, you tell a borrower what the rate is, and it's all about the rate, right? And they don't think about the payment. And as in the mortgage industry, we don't even really look at what money you have to make that payment to live on. So we have to dig deeper to be able to say, all right, so after taxes, which we don't look at in the mortgage industry, but after taxes, this is what your net income is. These are the expenses that you have. You have this amount of assets, liquid assets. Let's look at paying a little bit more down, or to make sure that you are comfortable with what the payment is. It's all about the payment. And if it goes to a 40-year mortgage and investors are okay with the risk of a 40-year mortgage, then why not put home buyers into that?
You know, that's a really good point. If I can just piggyback on that, you know, the question is, why do we qualify everybody on gross income when it's superficial? Some of these programs that I'm talking about, by opening up your source data and your federated repositories to actual cash flows, you can actually analyze what type of cash availability they have to truly make an affordable payment and have a life, by the way. You don't want somebody to have a 45% front end and a 65% back end ratio that can't ever go out to dinner. I mean, you're going to miss a payment. You know, you're 2 payments away from bankruptcy with that type of a scenario. I think we really need to, again, I think some of these non-agency people are looking differently about how to qualify people, how to look at historically how they have paid their bills, the credit quality of the borrower. You know, some of these new Vantage scores that's not typically like one of the bureaus. There's many ways to look at how I pay my cell bill, how I pay my rental before I buy a house. I think looking, overall, looking at the borrower and finding ways to say, this is a good risk, and using predictive analytics along with all those character and historical nuances to ascertain if this is a good borrower. I think that's the direction that a lot of this is going to go. We have been doing that with high net worth people, right? We just say, well, just put a whole bunch of money down. We really don't care what you make. You're self-employed. I'm not sure what you make, but as long as you have 20% down or 30% down, you're not going to default. When you get into, 3% down, 5% down, whole different ballgame. There's a lot of risk there. But I think that the technology's out there to look at borrowers much differently.
So I really like this question that came into the Q&A, right on topic. In an environment where profits are shrinking, how should lenders balance between focusing on borrower experience and operational efficiency? For example, should they move budgets towards tech that helps with operational efficiency rather than spending more money on POS systems? Jody, I'll start with you. John, would love your input, and Jenny, if you have any as well.
I think I almost feel like a point of sale solution is like a point to entry for a lot of home buyers. That's how they want to do business. So there are a lot of great solutions out there that you don't have to develop your own, that in a very short period of time, your home buyer can be going on a mobile and doing a mobile application. I think if today your game plan is to start today, I fear that you might be a little bit late. It's very important in the mortgage industry that when things are going really well for you, such as 2020 and 2021, that's not a time to sit back and be excited about what you're doing. It's a time that's when you're mending the ship, you're mending the sails of the ship. So when the next storm comes, you are prepared. So those mortgage lenders who have had that same, kind of vision vision and leadership within their industry, they're already applying technology. There is, I don't think that today is the day you necessarily want to jump in, because it costs a lot of money to initially to launch technology before you, as Jenny said, before you start to see that return on investment. It takes a little bit for it to work. And there's a lot of lenders, if you aren't applying technology today, you're not going to see that return on investment, and potentially not fast enough when you're in margin compression territory. So I think that the goal should have been to start before, but if you haven't, there are solutions out there that you can have return on investment, capacity being one of them. It's a very short time to entry, but for those softwares and technologies that take a long time, if you're going to build it yourself, I wouldn't suggest that. But if you're going to work with a technology partner, there is some technology that can be painlessly implemented, and you can start to see return on investment in a shorter period of time than before. So the point of sale, I'm shocked that there are still people in the industry that don't have that avenue. But it's always start somewhere, start small, start in areas where, you aren't impacting the manufacturing process, don't impact the loan officer, don't impact the consumer, at least if you're doing it on your own, so that you can get up there. But I really think that over the last 2 years, and one of the reasons that I feel so optimistic about this year is because we're constantly putting standard operating procedures into place, building infrastructure, building technology, so that it's a pivot, right? So we have to be extremely agile. And some lenders, I noticed, Diego, in the chat too, someone asked how long till we see lenders cutting margins below profit and sticking around. And it's like until they run out of money, or at least until their balance sheet gets so low that their investors, that the investors aren't happy with what those balance sheets are, or until they decide that this isn't the game for them anymore. And I think maybe some of those that haven't applied any technology and worked on their infrastructure the last 2 years, that it's not going to be long.
John, operational experience versus borrower experience versus operational efficiency. What are your thoughts on that? Is that really a trade-off?
Yeah, I think that, Jody started this discussion by saying anything you do technologically has to be strategic to your overall business plan. And I don't think you can segment, hey, I'm going to automate customer acquisition, or I'm going to automate the customer experience, or I'm going to automate better sales protocols to hire people. I'm going to automate just operations. I think you need to look at the enterprise and say, how can I achieve my objective, whatever that is, whatever your strategic objective is, and more profitability obviously is a big part of that. I think that's the first thing. The second thing, and Jody alluded to this, I have never integrated anything, whether it's manual, technologically, analytic-wise, without doing a cost-benefit analysis. In other words, if I spend X, what am I going to get back in the performance of this tool, and how long is it going to take me to get it back? Because I can spend $300,000 in marketing, and if I get $1.1 million back net, hey, I don't need to be a Wharton MBA to figure out that's a pretty good investment. I think people don't track well enough their investment in automating something and what they get back for it. I think that's a critical part of what's lacking in a lot of people making a decision about technology. It's like they ask Jane, hey, do you like it? I love it. Okay, it's good. Well, what is it doing to my business plan? And I think the triumvirate of production, operations, and finance, that's the three legs of the stool that should never be separated. That's how the business should be operated. And that's a healthy way to grow a business. It's more productivity with less people and higher quality of loans delivered faster. There's your business plan.
Jenny, we'll take it out with you. Would love any guidance on when we can expect that next profitability report. I think I think Q4 versus Q3 is going to be really interesting. And any final thoughts that you have on the panel today?
Yeah, so absolutely. Just some, retrospective analysis. I think that's what we can look at, right? In 2018, we saw purchase share percentage for the IMBs at well over 80%. And 2018 was not a good year in terms of profitability for the IMBs. So they had about 14 bips for the entire year. It was the second lowest actually ever for our study. But that's just an example of things on the extreme end. As of January, our forecast is showing purchases to be around 66% of mortgage originations for 2022. So obviously, we likely won't see what we saw in 2018, and we might want to look to a year like 2019 because that actually we had almost identical purchase share in that year of about the mid 60s. And once again, the net production income was about 58 basis points, which again, is just about average.
Well, it's been a really fun chatting with the three of you, Jenny, John, Jody. Hope you have a great weekend and take care of yourself.
Thank you so much for having us, Diego.
Thank you.
Bye, everybody.
Bye.